This is P13-44B, and we're going to go through some journal entries related to dividends and treasury stock transactions. And I believe in this question we're also going to put together the equity section of the balance sheet. So let's start with this first one. So we're declaring a cash dividend on the 6% $97 par non-cumulative preferred stock, and also a 25-cent per share dividend on 105,000 shares of $8 par value common stock. So the date of record is January 31st and the payment date is February 15th. So this is the journal entry for the declaration of this dividend. So what we do is basically we're going to have cash dividend that's being paid both to our preferred stock and our common stock. So we're going to have this cash dividend account. Since it's the declaration date, we're not actually paying out cash. So we're going to have dividends payable common and dividends payable preferred. And so now let's go ahead and calculate what the amounts are. So for the preferred stock, the par value of the preferred stock is going to matter because it's a percentage of the par value. So we're going to need the number of shares, the par value, and the percentage, which is the preferred return. So this 6%. So let's put it all down, 6%. $97 and 1,150 shares. So if we just had one share, it would just be $97 times 0.06, but we have 1,150 outstanding, so we multiply that, and so we get this value for our preferred dividend. So it's a liability. And so now let's do the common stock. So it's 25 cents per share. And so for common stock, it's giving us the per share dividend. The par value for the common stock dividend is not relevant. We don't really care about that. So it's just the dividend per share multiplied by the number of shares. So when we multiply these together, and so we will add these up. And we declared a cash dividend is our memo. Okay. So next we're going to pay the cash dividend. So basically these dividend payables are going to get cleared out and we're going to pay out the cash. So we pick our accounts. We're going to have our two liabilities that we're going to clear out and the cash. Paid cash dividend. Okay. Okay, so now we have a split of common stock 2-for-1. And actually on this date, this is August 31st, 2020, Tesla stock had a 5-for-1 split. So it doesn't really affect the accounting books. You're not issuing new stock. It's just a pure optics kind of play where you want to reduce the per share price by just splitting the number of shares up. So the number of shares increases, but you're not issuing anymore. You're just taking what exists and dividing them up. Kind of like if you have one big pizza slice and you cut it in half, it's not like you have more pizza. You've just divided the same slice into more pieces. So it doesn't add more pizza. It just re-divides up what already exists. So we actually don't need any journal entry for this transaction. Okay, so next we have a 50% stock dividend on the common stock, and the market value of the common stock was $11 per share. So remember, when we're doing stock dividends, the percentage of the stock dividend matters for our accounting. So the main difference is going to be that since this is a large stock dividend, it's greater than 25%. We're going to, instead of using the market value of the share, we're going to use the par value. So we also have to be careful. We did this 2-for-1 stock split. So at the beginning, we were told that there were 105,000 shares issued and outstanding. This 2-for-1 split made that go to 210,000 shares. So when we do this, we basically have stock dividends, and we're also going to have, again, this is a declaration date, so we're going to create a liability, common stock dividend distributable. And so now let's think about how we want to do the calculation. So we have 210 shares outstanding after the stock split, and we're going to do a 50% stock dividend, and then we need a value per share. We're not going to use the market value. We're going to use the par value, which we were told was $8. But again, the 2-for-1 stock split also cuts this in half, because you're basically taking 105,000 shares at 8 and going to 210,000 shares at 4. So it's the same total, but you're just doubling this and halving this. So the net effect is 0, but you still have to remember that this par value is cut in half. So it's $4 per share par value. So let's multiply all these together. So 420,000. dollars. So make sure it's not issued. We're still just declaring it because we created this liability. Okay, so now we're actually going to distribute the shares. So we're going to reduce our liability, and we're going to actually issue the common stock. So again, notice this stock dividend did not bring any new cash into the business. It's just a way to distribute ownership to the shareholders, and if there's a liquid market, those shareholders could sell their shares. But basically, it's not bringing new cash into the fold of the business. So I would say in the real world, for most public companies, a stock dividend is pretty rare, especially a 50% stock dividend, because if you did one this large, it would cause the market value to decline probably commensurately. So this is just a kind of pseudo stock split that's similar but yeah, it's rare, but you should just know the accounting for it in case you ever see it. Okay, so now let's move on. So we purchased 1,400 shares of treasury stock at $9 per share. So basically we need to figure out how much cash we paid. So we take our 1,400 shares, it's $9 per share. So if we multiply those two together, it's 12,600. So when we buy treasury stock, we're using cash, and we are buying treasury stock, common. Okay, now we sold 700 shares of treasury stock for $11 per share. So it looks like we made a little profit here. We bought from the market at 9, now we're selling at 11. So let's do the math. $11 a share times 700 shares is $7,700. Okay, actually, let's be a little careful here. So we know we're bringing in this much cash. And so what are the other accounts that we're going to use? So we're going to have treasury stock. But remember, we paid $9 a share, so we can't just forget that the cost basis was $9. So we're also going to have this paid in capital from treasury stock transactions. So this is when we have an excess of our cost basis on these treasury stock transactions. So we paid $9 a share. So 9 times the 700. So 6,300 is from our treasury stock, which we bought here, and the rest of it is going to be excess paid in capital from treasury stock transaction of 1,400. And so you notice the different options here. We sold treasury stock above cost, that's why we have this additional paid in capital. If we sold it below cost, it would be slightly different. We'd have an additional debit to make everything match, but in this case we sold it for above cost. Okay, so now we're going to see the other situation where we sell it for a loss. So we're going to have cash, we're going to have, in this case, I'm just going to line it up because I kind of foresee what's going to happen here. So actually, let's do this. Let's calculate what the loss is. So it's 500 shares, and it's $6, and our cost was 9. So the total loss is 1,500 because our cost was 4,500. We're only getting $3,000 of cash, so we actually know what this is. And so when we sell treasury stock for a loss, we first basically zero out any paid in capital from treasury stock. Any balance in this, we first get to 0, and if there's any excess from that, then we take it out of retained earnings. So in this case, our loss at 1,500 exceeds our paid in capital from treasury stock transactions account by $100. So we're not only going to have to zero this out by debiting it, we're also going to have to debit retained earnings by an additional $100. So let's see how this is going to work. So basically we have our numbers here. This treasury stock was worth $4,500, so we're now basically going to reduce that balance, or rather, yes, sorry, so reduce the treasury stock balance. It's a debit normal account, so by crediting it we are reducing it. And then we had our zeroing out of this 1400. So now we've used up as much paid in capital as we can, but we still are $100 short on the debit side. So then we debit retained earnings by 100. And so this is sold treasury stock below cost. Okay, so now we've done the transactions. Now we want to basically fill out our equity portion of our balance sheet. So we're going to have to basically look back and see what happened, and also it looks like it's giving us some information here. So let's think about how we're going to do this. Okay, so let's start with our paid in capital. So obviously the first thing we want to do is list our preferred stock. And so we have preferred stock, 6%, $97 par value. And so how many shares did we have? It told us up above, I believe, let's see. Okay, I think the pattern is we're going to put the number of authorized here and then the number of issued and outstanding here. So it tells us that there's 1,500 shares authorized. And then we saw above that there are 1,150 shares outstanding. Okay, so then what is the math to figure out what we should put here? It's basically our par value times the number of shares issued and outstanding. So that's equal to 97 times 1150. Okay, so now let's do our common stock. So remember we did a stock split. They're trying to test you here. It used to be 8, but we did the stock split, so it's actually $4 par value. And we had 500,000 shares authorized. And then how many do we have outstanding? So, okay, so this is a little tricky. We're going to have shares issued and then a separate number of shares outstanding because we did some treasury stock transactions. So let's first do the number of shares issued that is sold or distributed to our shareholders. So how do we do that? We know that we started off, it tells us, with 105,000 shares before all of our transactions, which we got from right here. And then we did a 2-for-1 stock split. So we multiply this times 2, which is, we didn't have an entry here, but this did happen. And then we did a 50% stock dividend. So that's going to increase the stock, or rather the share count, by 50%. So we multiply this by 1.5, or basically, let's make this a little more clear, by 50%. So we issued 105,000 more shares. So if we take the number of shares outstanding after the split plus the number of shares issued in the stock dividend, we get a total of 315,000. Sorry. So let's go put that down in our sheet here. So 315,000 shares were issued, but then remember we did some treasury stock transactions. So we bought 1,400, and then we sold 700, and then we sold another 500. So 1400 minus 700 minus 500 means so it means we have 200 shares in our treasury stock balance. So that means there's 200 less shares outstanding than were issued. So this is actually 314,800, which is basically the number of shares issued minus the 200 shares we have in our treasury stock balance. This is the number that are outstanding. And so now let's think about how we want to compute the value. So the question is, we know the par value. Do we use this number of shares issued or the shares outstanding? So we're going to be accounting for the treasury shares below. So if you think about it, this 315 is the number of shares that were actually issued and out there. And so we're going to first use this number. We're going to use the number of shares issued. And then later we're going to basically account for this 200 share difference with our line item for the treasury stock. So for this part of the balance sheet for common stock, we're going to use the shares issued because those were the number of shares that were out there at some point. So 4 times 315,000. Okay, so now when we add this up, okay, so that's our paid-in capital. Now we're going to have our other items. So we're going to have retained earnings, and then we're going to have our treasury stock. So retained earnings, let's see, the ending balance for retained earnings, it tells us is 2,080,000. And then the number of treasury stock that we have, we saw this already when we did this calculation for our shares outstanding, that there's 200 shares still held as treasury stock. So this is treasury stock, shares at cost, and that cost, if you recall, was $9 per share. So 200 times $9 is 1,800, and it's going to be a subtraction. Because this is cash that came out of our business to buy this treasury stock. So it's basically when you issue shares, you're receiving money, which is accounted for here. But when you took money or cash out of your business to purchase treasury shares, you got to make sure that you're subtracting it out here. So then when we do the math, when we add total paid-in capital plus retained earnings less treasury stock, we get this total, and that's it.